Okay, so P4-30A, and feel free to ask questions while I'm doing it. This is not a real fancy video. It's just to get the information across to you. Okay. So the adjusted trial balance for Bradford Irrigation System at December 31st, 2018 follows. So here's your icon, and you can open that up. So what do we mean by adjusted trial balance? That means that all of the adjusted entries have been made, and the balances in each of those affected accounts have been updated for those entries. Okay, so I think in some of your homework you might see it in a column type format. Like you have the unadjusted trial balance sitting in the on the left, and then you have the actual adjustments, debit and credit column for the adjustments. Then you have the adjusted trial balance, and that's just starting with the unadjusted amounts and then taking those adjustments into consideration and coming up with this adjusted trial balance. Okay, they just left the unadjusted part out and they've left the adjustments out, and they're showing you the end product here. Okay, and what we're supposed to do is we're supposed to make financial statements using the adjusted trial balance. Okay, so the first financial statement that we always make, and everyone should have this solidified in their mind now, is we always start with an income statement. Okay, and the first line item on the income statement is revenue. Okay, so we're going to look at our trial balance, and we're going to look for any revenue accounts. And if you have your trial balance set up neatly, I'm not saying correctly, I'm saying neatly, then you would have your accounts kind of grouped by the type of account. So notice, it looks like they have all their assets first, right? Then they have their liabilities, right? Then they have their equity, common stock and retained earnings, including dividends. Then they have the revenue. Then they have the expenses. So that's a really nice way to set it up. Then when you get ready to prepare your financial statements, your eyes can scan down to where the revenue is. You already have an idea where your revenue is, and it's sitting right there, service revenue. So we'll call that service revenue, and we will put in, right there it is, 70,000. Okay, so your service revenue is 70,000. And the nice thing about this is you could actually, if you had a hard copy trial balance sitting there, you could draw a line right here. You see where my mouse is going back and forth? And everything below that line, imagine a line being there, that would be all of your income statement items. Okay? So it helps to set up neatly ahead of time, then it makes the later work easier. So I have all the expenses sitting here, and if I had the ability to just copy it over and drop it in here, I could, but unfortunately I'm going to have to do them one by one, right? Now, usually in a formal income statement, you would show the bigger expenses first and make them descend inside by amount, right? I don't know if your problem's requiring that. That's when I like to look at the green notes here. It says if a box is not used, leave the box empty, do not select the label or enter a 0. Okay, so it's not telling us to do that. I'm going to take a chance and not do it. Just when you're looking at financial statements, maybe you can pull up an annual report of your favorite company, Coca-Cola or IBM, and take a look at the way they list their expenses, and they're going to show the bigger ones first going down. For ease here, I'm just going to pull them across as they are, okay? So let's see, insurance expense. And if we get it wrong, and we'll read what it says when we get it wrong, then maybe it wants us to order them from largest to smallest. So where's insurance expense? Then I got salaries expense. I might as well put the names in, right? I got supplies expense. And I'm just taking those names right from my trial balance. I got interest expense. I got depreciation expense on the equipment. I got depreciation expense on the building. And somebody kind of double check. Does it look like I got all of them? 1, 2, 3, 4, 5, 6 expenses. 1, 2, 3, 4, 5. Looks like. And I'm going to leave the other rows blank because that's what it told me. Right? If I don't use a row, then just leave it blank. Okay? Does everyone follow me so far? This is a great problem. It's a fun one too. Flies in it. Okay. And then what do? We add them up. So if you can add them in your head, that's fine. Don't feel bad if you can't. I'm going to use the calculator today. You probably have the answer if you can add it in your head already. Okay, so after adding up my expenses, it looks like I have total expenses of $24,700. I'll put that in there. Those are your total expenses. Does that make sense so far? So I got my total revenue sitting here. I got my total expenses down here. And the difference between my total revenue and my total expenses will be my net income. In this case, it's net income. Notice the label on this financial statement. See the parentheses here where my arrow is? Right? So had it been negative, had the expenses been more than the revenue, you would show it in parentheses, meaning negative, right? And it wouldn't be called net income, it would be called net loss. Okay? So in this case, it's going to be net income because your revenue exceeds your expenses. Any questions on that before I go forward?
Wait, where'd you get the 70,000?
The 70,000 is the revenue. See service revenue? If you look for service revenue on your trial balance,
Okay, got it.
70,000. Good question. Okay.
How did you get the net income?
Well, your net income is your revenue, your total revenue minus your total expenses.
Oh, okay.
The difference between your total revenue and your total expenses. Does that make sense? All around? Okay. We got to get that solidified, right? We got to know that like the back of our hand. Okay. Let me check it. Looks like we did okay. Our math is fine.
So, revenue is what you gotten in for your business, and then expenses is what you, like, bought stuff for your company?
You're right on the right track to that answer being correct. Now, revenue, you don't necessarily have to have received it in cash.
Yeah.
Revenue is what you've earned for what your business does.
Yeah.
Your business either provides services, like in this case, this business is a service business, or you sell goods. But the thing is, the way we account for things, right, we account for that revenue when we've provided those goods or services, whether we collected money or not. Okay, so you're correct, but start using the word earned, right? For revenue is what you actually earn. And that's the same for expenses. You don't necessarily have had to have paid for the stuff, like you say, bought stuff, or paid for any services that you use, but you have to have incurred those expenses. So if, like in this case, if people worked for you, see salaries expense, and everybody probably knows this, you don't get your paycheck the day you work, right? You usually get it every 2 weeks. Okay, so now imagine if that paycheck comes on January 5th, right? But you did some of that work you did in December. When we make that December 31st financial statement, there's going to be salaries expenses in there that haven't been paid yet, but they're still expenses. They're reducing net income. Okay, so for expenses, we record them in our accounting system when we incur them. Okay, when we receive the benefit related to those expenses are going to be on our income statement. They have to be part of the net income. They have to be part of that net income calculation. Okay, so it's not necessarily what we got in cash and what we spent in cash. Although cash is going to be part of it, the timing of it doesn't have to fall in line. Okay, that's a good question.
And
So.
and then net income is your, what you gotten from.
Think of it like this, it's the net earnings.
Yeah.
If you call revenue earnings, and the expenses are incurred to make that revenue, right? In a business, we wouldn't want to have any expenses that don't help us get more revenue.
Yeah.
That's the idea about business, right? Whether it's the accounting people in the accounting office, or the human resource person, or the salesperson. it all goes into making this business make money, right? Okay, so net income is really the net earnings. It's your revenue net of the expenses, meaning the difference between your revenue and expenses. Yeah. So it's really your earnings, your bottom line earnings. Okay. Everybody okay with that? Okay. And it's accrual based, meaning that we're going to record revenue when we earn it, and we're going to record expenses when they're incurred. Okay. Which doesn't necessarily align with the cash flow. Cash flow can be different. Okay. Now, what's the second financial statement we make? Well, we always make the retained earnings statement after the income statement, or statement of retained earnings, if you want to call it that. Okay. Now, the thing is, we got to be careful here. This is a new accounting student mistake that generally is made, and it's okay because you need to make this mistake. People will come over here to their adjusted trial balance, and they'll use this retained earnings figure of $12,000 on their balance sheet. The problem is that $12,000 is not your ending retained earnings. And the way you can tell, one way, is that all of these things that come after retained earnings wouldn't be sitting there if it was the ending retained earnings. All of those things would have got rolled up into retained earnings. Okay, so those things can't be sitting out there separately if that's your ending retained earnings figure. So that's really your beginning retained earnings figure. That's the January 1st retained earnings balance. So I'm going to start with the 12,000 here. Okay, anybody remember what we do to come up with ending retained earnings on the retained earnings statement? Right, you should have these statements, actually the structure of these statements, you should have them memorized. Okay, we're going to add the net income. That's why we had to figure net income out first, because net income gets added to the beginning retained earnings, okay, on our path toward ending retained earnings. Okay, so I'm going to have a subtotal here, and I'm going to have 57,300. I just added the two. Then the other thing that happens is we subtract the dividends. Okay. Why don't we subtract the expenses too? It's a real simple answer. Can you tell me? Because the expenses have already been subtracted when we came up with the net income figure. Right? That's net income. Expenses were already considered. Okay. I got to make one double check here on the rules that they give me. Do they want me to show this dividend in parentheses or as a negative? Let's check. If a box is not used, do not select the label. Use minus sign or parentheses to show a net loss. You know, I might just put it in there because we're subtracting. It's different than adding, right? So I got 54,200. And if we get it wrong, we'll just make the correction. Looks like we're okay. So we didn't try it without parentheses. If you're probably gonna go through this a few times so you learn it. That's the point of having multiple chances at the homework, the way I set it up. So in one of your tries, you might want to just try to put it in as a positive number, but still subtract it and see if the system allows you to do it that way. Okay, it does. Okay, as long as you're doing the math correctly. Then we go ahead and make the balance sheet, right? And the balance sheet follows the basic accounting equation. It shows your assets and the total assets, and it shows that those total assets equal the combination of liabilities and equity. Yeah? So the first thing we're going to do, and I think it takes it in sections, right? It looks like it's going to do the asset section first. Okay? So that, we come over here to our trial balance. And like I was saying earlier, it's nice because our trial balance is set up to where all of the assets are listed first. So we can pick assets off of there, and we're going to start with our current assets. Now, what's a current asset? If you had been reading, and you're supposed to be reading, okay? I mean, I really stress the homework problems and doing them, but you still need to read to get some of the conceptual stuff. current assets are any asset that's going to be converted to cash within 1 year, or is going to be used up within 1 year. So things like supplies, those are current assets because you're going to use them up. Accounts receivable, right? You're probably going to collect your accounts receivable before a year is up. I hope you do. If you're not collecting your receivables between 14 and 30 days, then something's probably going to be wrong, right? You can't wait a whole year to collect the receivables because the business needs cash to run. Yes?
And then what would be the long-term assets?
Things that will not be used up within a year. So if you think of things like equipment or a building, right, that's going to last you more than a year. It might last you 10, 20, 30 years, right?
You wouldn't put it in the accumulated depreciation?
You wouldn't put it in the current asset section, right? Now the accumulated depreciation, what kind of account is that? That's called a contra asset, right? And it's usually married or paired to the related asset account that it's with. So when we get to that point, I'll show you how to do that. For now, I'm going to put my current assets in. Now, like I was saying with the income statement, expenses we show biggest to smallest, right? Assets we show the most liquid to the least liquid. And liquid means how readily it's convertible to cash or how quickly it's going to be used up. So cash, of course, is the most liquid asset. We'll show that first. And I believe our trial balance is kind of listed in the order of liquidity, so we don't have to harp on that too much. Okay? Receivables are probably going to become cash much quicker. What does this say? Office supplies. Okay? Maybe I'll just list them. And then we've got prepaid insurance. Okay, so let's see. So these are all your current assets. Okay. And then I'll go ahead and add them up. So what we're doing is we're doing a classified balance sheet. And it's not classified like top secret kind of thing. It's classified because you have categories, right? You're breaking your assets up into current assets and long-term assets. Well, building and equipment are not long-term assets. I'm sorry, building and equipment are not current assets. They're long-term assets, right? You see what I'm saying? Then you'd come down here and you got your long-term, what do they call them? Property, plant, and equipment. Another name for long-lived assets. Okay? And in this case, move your calculator out of the way. You could find your building. So I'll put my building in. And my building is 61,000. That's the cost of the building. So we always show our assets at their cost. Okay? Our property, plant, and equipment, and our long-lived assets. We're going to show them at cost net of their accumulated depreciation. So you got the building's accumulated depreciation. Right? There's your contra account. And I'm going to put it in as a negative again. Accumulated depreciation of 24,200. Okay? So we're going to show that net figure, the 61,000 costs minus 24,200. We're going to show that right out here. Okay? And then we'll do the same thing for the equipment, I believe, right? There's equipment. And there's accumulated depreciation on the equipment. Okay, so my equipment's cost is 20,000. And the accumulated depreciation is 7,000. See, my accumulated depreciation balances are credit balances. That's why they're showing up as negatives in the asset section, because assets have normal debit balances. Okay, that comes out to 13,000 net, right? 20,000 minus 7,000. So now we're going to make a subtotal. Total property, plant, and equipment. And that will be the combination of the net building of 36,800 and the net equipment amount of 13,000. Okay? So we're gonna have 49,800. Just adding these two. Okay? And then what we're gonna come up with now is total assets. So your total assets are gonna be the combination of your current assets and your property, plant, and equipment. Okay? So you can add those two. If you're working along with me, your numbers are probably different. Are they? Yeah. And you're gonna find that when you take a second attempt at the problem, your numbers probably will change too. But that's good. Let's see if I did the math correct. Okay, well done. Take a look at that. Okay. Question.
Never mind.
You got it?
Yeah.
Ask the question anyway. Somebody else probably has it.
No, I didn't know what to put at the bottom, but it was total property, plant, and equipment, right?
Yeah, that's for this category here.
Okay.
Right. And the very bottom is the combination of the current assets, 81,700, and the 49,800 in property, plant, and equipment. Does that make sense to everybody? And notice this is the third financial statement that we do, and I'm going to show you that reason in a minute here. Okay, you're going to know why. Okay, now we do liabilities. Liabilities, again, we're going to have current liabilities. Anything that's due within a year. Okay, so use the year. For academic purposes, we'll just work off a year. Anything that's due within a year. Now, if our trial balance is set up correctly, or set up nicely, right, the next set of accounts after assets will be your liabilities. And I see 4 liabilities. Oh, actually, I see 5. Okay? They're highlighted in blue. You see them up there? Oh, the blue went away. Okay. I got accounts payable. I got interest payable. Salaries payable. Gotta scroll around a little. Unearned revenue. Okay, those are all of the things that are going to be paid off, or they're going to go away within a year when you think about it. Okay, you're probably going to be paying your payables pretty frequently, at least every 15 days. Interest payable, that's done monthly, more likely than not. Salaries payable either twice a month or every 2 weeks. That gets paid off. And then unearned revenue, you probably will be doing that as you perform the services. Right? That probably will disappear as you move along. So all of those are going to decrease within a year. Okay. So I'll drop those numbers in. We got accounts payable of 35,000, interest payable 2,000. We got salaries payable. Make sure I'm lining them up correctly. 4,100. Unearned revenue of 1,900. Okay. You guys follow what I did? Okay. So you can add them up if you're adding already. And I'll go through the addition. Oops. Watch your zeros. Okay, so those are my total current assets. 43,000. We'll go total current liabilities, right? We're working on liabilities. Okay. So rewind what I just said. These are all of your current liabilities, 43,000. Then you're going to have your long-term liabilities, right? And the one long-term liability that you have sitting there is this note payable. A note payable is a loan, right? So this loan is probably something that's going to be paid off over several years, not just within 1 year. Okay, that's why it's sitting in the long-term liability section. And we're going to call that notes payable. And that'll be 11,300. So when you add your current liabilities of 43,000 and your long-term liability of 11,300, you're going to end up with your total liabilities. So you're going to have 54,300. So far, so good? Everybody follow that? Okay, now you do the equity section. What are the two components of equity? Should have it kind of in your head now. There's two main things in equity. Yeah, exactly. You guys got it. Common stock and retained earnings. So I'm going to put I'll do common stock first. And I can pull that right from my adjusted trial balance, 23,000. So this is where the mistake usually happens. Okay, because you've got all of these things going on in your head, and all of a sudden you're looking at the trial balance to get all of the stuff up into this point, and you look over here and you get the 12,000, and you put it in here as retained earnings. Okay. And what happens is you go down and you add all of this up, and it doesn't balance. It doesn't balance with the total asset balance. The reason is you have to use the ending retained earnings. The ending retained earnings comes from where? Comes from that previous financial statement that we did. It's sitting right here in the retained earnings statement. So you have to use this 54,200, right? That's your December 31st retained earnings. 54,000. Oh, what did I? 54,200. Okay. So that will be your total stockholders' equity when you add your common stock and your retained earnings. So I got 77,200. Okay. Now what I'm going to do, I'm doing the basic accounting equation. I'm going to take my liabilities and add them to my equity. So my total liabilities of 54,300 plus my total equity of 77,200. Right? So I got 130. What is that? 131,500. So I just did that in my head. 131,500.
It should be a mirror to
It should be, but don't just go ahead and drop that number in. You got to do the math, right? Because if you just drop that number in, that number will be correct, but something else in here might be wrong if you didn't do the math. So you want to verify that it does add up, and it does. 131,500. The other place where you could make an easy mistake is labeling it, because a lot of the labels are very similar. So I didn't scan it. I'm going to plug it in, and if we, okay, good, we made a mistake. So that's great. Read your mistake when you make it. Make sure each line of the balance sheet is properly labeled. Pay close attention to the section of the balance sheet you are being asked to prepare. Recall the format of a classified balance sheet, and remember to leave any unused cells blank. Please try again. So let's go down. Oh, see? Did you see it? You see what I did wrong? This is good. It's really the label that we messed up with. Okay? So your brain, prior to this, we were thinking about assets. So in your head, you're thinking assets, assets, right? And you get down here, it's time to do liabilities. And what did my brain do? It labeled this category current assets. That should have been called current liabilities. We probably said that while we were doing it, but we labeled it current assets. And we'll just scan through real quick to make sure we're okay. I think we're okay. So it could be something as simple as that. Be careful. Okay. You have to be careful. Okay, so we're in balance, right? Our total assets equal our total liabilities plus our total equity. Okay. Now we're going to close the accounts. So we close temporary accounts, and I'm going to tell you what the temporary accounts are. Your temporary accounts are your revenue accounts, your expense accounts, your dividend accounts, and this special account that we have at the end of the whole process called income summary. That's where we summarize our net income. Okay. So they're temporary accounts because they're kind of like a scorecard. When the game is over, everything goes back to zero. Okay? So balance sheet accounts are permanent accounts, right? Because that shows you your net worth in perpetuity. As long as the company is going, that shows the net worth of the company. Whereas the income statement accounts and the dividends are only open for the accounting period. And then we turn them into zero so we can keep track of the next accounting period. Okay? So the first account I'm going to close is called revenue. So you just look at the revenue account and it's service revenue and it's sitting there with a credit balance. So now that you know your debits and credits, if I wanted to get rid of the revenue balance and it's a credit balance, what do I have to do to the account to make that 70,000 go away? I have to debit the account. So I'm going to debit service revenue for 70,000. That makes the service revenue balance into zero by doing that. I have to stick it somewhere. Service revenue is an income statement account, so we'll stick it into an account called income summary. Okay? That's where we're going to summarize net income. And we're going to also use that account for the expenses. Okay?
Does this always does that with the income summary? When you close the revenue? Is it always the income summary?
Yes.
Okay.
We're always moving, we're basically moving it out of revenue and putting it into income summary. Yeah, that's a good question. Yeah. Anybody? Questions? So this can be kind of confusing, but it's really actually simple. Okay. Now, okay, you saw what I did. Now I'm going to close the expense accounts. So you might want to look at the expense accounts and notice I have these expenses. How many did I have? 1, 2, 3, 4, 6 expenses, and they all have debit balances. So if I wanted to get rid of those expense balances and their debit balances, I have to credit those accounts. Okay? I'm going to skip a line because I like to show my debits first. It's not all the way necessary, but I'm going to make those credits first. So I'm going to skip a line so I have a space for my debit. And I'm going to put all those expenses in. Insurance expense, I guess it gets kind of tedious. Salaries expense. I'm just looking over here on my trial balance. Supplies expense. We got interest expense. We got depreciation expense on the equipment. And we got depreciation expense on the building. And I'm just going to make credits. They've got debit balances. To get rid of them, I got to credit all of them. Okay, and hopefully I put the labels in that align insurance, salaries, supplies. We got interest, 2,000. We got the equipment's depreciation expense, 2,800, and the buildings. Okay, so if you totaled those up, those would be your total expenses. Okay. Here's a little trick. Instead of doing the math again, why don't you just scroll up to your income statement and get that total, right? My total expenses were $24,700. Okay. So I'm going to debit income summary for that total. Okay. So we'll make a little side note here. I'll do something for you. If you were to have, if you had kept a T account, and I recommend you keeping T accounts for all of your accounts. Those are your ledger accounts, okay? Had you had a T account for, and let's see, okay, for our new account called income summary, which comes into play at the end of the accounting period. That's really the only time that you use it. Okay. Had you kept a T account, you would have had that credit right here. See that 70,000? That would have been credited to income summary. That would have been the revenue, right? The closed we'll just say close revenue, right? You would have closed revenue to income summary. And look at this second journal entry. You would have had a debit of 24,700. And that's to close expenses. Okay? So if I were to take a balance in income summary at this specific point in time, at this stage, I would take the difference between 70,000 and 24,700, and that would be my balance. Right?
How'd you get that 24,700?
I added up the expenses. See in this journal entry?
Okay, I see.
Yeah?
Alright.
So I'm basically closing all the expenses. Now all of the expense accounts have zeros in them.
Okay.
That was the whole purpose, right? But what I've done is I've summarized my net income in income summary. So you could go back and compare that. That's the same net income that's sitting on your income statement. See that? 45,300. So we've basically summarized net income. We need that account. We need this income summary account in there so we can close the revenues and expenses. But now we're done with it. Because where does net income go? Where does the net income from the income statement go? I mean, it's like staring right at you. Where does the net income go? Well, that's where it's being shown, but where does net income go from the income statement? Well, revenue is part of net income, but once you've got the net income on your income statement, where do you take that net income? Equity, yeah, but what account in equity? You can't see the forest because of the trees.
Retained earnings.
Yeah, look right up here. Doesn't that net income from the income statement here go over to retained earnings?
Oh.
So we have to make a journal entry to reflect that. We gotta close that net income out of income summary and put it into retained earnings. Okay? So if my income summary is showing a credit balance, what do I have to do to income summary to get rid of that credit balance? Debit it. Okay? So that's gonna be your third closing entry. Wait. We gotta finalize this, I'm sorry. To close expenses. Okay. So you probably could come up with the balance in income summary on your own just looking at this, but that's the reason I did the T account. So you can see that 70,000 credit against that 24,700 debit. Right? So now we got that balance, which is net income, and we know by having prepared the financial statements that net income has to end up in retained earnings. So we have another journal entry to make. I gotta take the 43,000 or the 45,300 credit balance in income summary, right? And I gotta debit income summary to get rid of it. What did I say? 45,300, right? And in order to get it out of there, out of income summary, I have to have an account to credit. I'm actually moving it into retained earnings. You see how I did that? Right? Retained earnings is increasing for the net income amount, right? So this is to close income summary. So we basically took net income and put it into retained earnings. We're making journal entries so our accounting system reflects what's on the financial statements. Okay? We can't just leave those amounts in those accounts because that's not what's in the financial statements. So we got to do the bookkeeping behind this as well. So that's what we're doing. We're closing the entries. Now there's one more thing. Go ahead.
Sorry, where did you get the retained earnings from? By the equity.
Yeah, retained earnings is an equity account, but the amount I got from income summary. From figuring the balance out in income summary, which is the total revenue minus the total expenses.
Oh.
Okay. All right. Questions? I still.
Wait.
Okay.
So the total revenue
Is
is what
70.
we started off with, right?
Yeah. See it right here? 70,000.
Okay. So it's stock minus,
Total expenses.
okay,
But it's really me taking those two journal entries, the first two journal entries, and posting them to an account
okay,
and finding the balance in that account.
okay, got it.
Yeah? So I basically took this credit, posted it to the account, and took this debit to income summary and posted it. And then you remember how to get a balance, right? You figure out what your total debits are and your total credits are, and you get the difference. And you put that difference on the side of the account that has the most. So since 70,000 is bigger than 24,700, that difference is going to sit on the side where the 70,000 is. So it has a credit balance. And then I had to zero this account out. Okay, so when I made that third entry, I actually did a 45,300 entry to close income summary. Okay. Now my income summary account has a zero balance because it's a temporary account as well. So that's gone. Now we're going to dump. What we did is we dumped all of that into a permanent account called retained earnings. Okay. Now what else affects retained earnings? We know that income from the income statement affects retained earnings. What's the other thing? Well, retained earnings is equity, you're correct. Stockholders' equity is a category. Dividends, right? Dividends. And if you think back to your retained earnings statements, dividends have a decreasing effect. Let's see, here it is, right? See the $3,100 dividend actually reduces retained earnings. Take a look at your trial balance. What kind of balance does dividends have? Dividends have a debit balance. So for me to close the dividend account, I have to credit the dividend account, and I'm going to debit retained earnings. See, debits actually reduce retained earnings. So I'll debit my retained earnings for $3,100, and I'll credit dividends. So that's going to have the effect of making dividends zero, and it's going to drop my retained earnings by $3,100 to close dividends. Okay? So those are 4 closing entries. Yeah. That's what we do at the end of the accounting period to get the temporary accounts ready for the next accounting period. Right? And retained earnings is a permanent account, so it's not gonna turn to zero unless you have zero retained earnings. You're not gonna close the retained earnings account. Okay. So far, so good. Now they want you to do a ratio. A ratio is kind of an analytical tool, right? And they want you to do the current ratio, which is your current assets divided by your current liabilities. So I'm going to take my current assets. They want you to name the ratio or define what that ratio is. So you're actually kind of spelling it out. Total current assets divided by total current liabilities. Where can I get that information? Right? Now you're turning into a financial statement user. Which financial statement am I going to find my total current assets on? And my total current liabilities. Balance sheet. Okay, so we scroll up, we find the balance sheet. Now it's just the current assets that we need, 81,700. And it's just the current liabilities, 43,000. And 43,000. Then we just come over here and I'll probably use the calculator to do that division. I'll go 81,700 divided by 43,000. So I got 1.9. That means that my total current assets are 1.9 times my total current liabilities, which is good, right? You wouldn't want your current liabilities to be more than your current assets, because that means that eventually the company will have trouble paying off its liabilities, because its assets are gonna deplete. Okay. It says, since the current ratio was 1.7 1 year ago, Bradford's ability to pay its current liabilities has increased, right? It has, relatively, it has more current assets compared to current liabilities than it did a year ago. Okay, so it's improved. And I'll go with that.